in leisure and hospitality hirings. Bars and restaurants, in fact, adding more than 150,000 new jobs. There are further signs that strength is coming back to the jobs market too. United Airlines saying it will start hiring hundreds of pilots as travel demand bounces back. The first major US carrier to announce a substantial rehiring of people that once worked, of course, in the airline industry. All this coming one day after blockbuster readings on manufacturing too. US factory activity soaring to 37-year highs in March. Strong factory growth in Asia and Europe last month too. Reopening optimism spilling into the energy markets as well. OPEC Plus announcing that it will gradually increase output by some 2 million barrels of oil per day in hope that demand will increase. A surprise announcement given Saudi's nervousness, of course, over supply hikes. Now, joining us now is David Kelly, Chief Global Strategist at JP Morgan Asset Management. David, fantastic to have you on the show. This jobs number at the top end of expectations. And I know your forecasts for the rest of the year actually are more optimistic than the Federal Reserve's. Your view on what we saw today in your forecasts?
Well, that's right. This was a blockbuster report. It was, you can add in to those 916,000 payroll jobs, you can add in an upward revision of 156,000 to the prior 2 months. So we're now about 1.1 million jobs higher than we were a month ago, according to the report. And remember, this is before the stimulus plan hit. I mean, this reflects the economy as it was in the week of March 12th. And you've still got all this fiscal stimulus coming. You've got the effects of vaccination on allowing for reopening. So I think this is the first of quite a few very strong employment reports. This is turning out to be, or will turn out to be, I think, a very fast economic recovery.
For all the forecasting, to your point, we're in a degree of wait-and-see mode because we've got the stimulus checks coming. We've got far broader stimulus for small businesses, for example. We don't know how much of this money is actually going to be spent and therefore what the impact's going to be on things like growth and inflation. So we just have to sort of give it some time.
Well, I think there are things we can analyze about this. I mean, one of the things that's very interesting about this particular stimulus plan is it's very aimed at lower and middle income households. And sometimes the government, has a big tax cut, but a lot of richer households get it and they save the money. But what we know from consumer surveys is that when you give it to lower and middle income households, they will spend it. Now, some of it is just catching up on bills, of course, but that still gives them the wherewithal to spend more money. And I think the combination of people finally having some money in their pockets and the ability to get out and do some things that they haven't been able to do for a year. And we're not quite there yet. I mean, we still have to get past the rest of the pandemic. But I do think that the pace of vaccination is very strong. So by the summer, the economy will be a good deal stronger than it is even in this March report.
What does this mean for Federal Reserve policy? In your own forecast, you're also saying that we could see inflation topping the Fed's approximate target, we discussed this on the show yesterday, of 2% in April and remain above that for the rest of the year. Obviously, the Federal Reserve has loosened the way that they look at inflation. We had Jim Bullard from the St. Louis Fed yesterday saying we would welcome it above 2%. But what do you think it ultimately means for policy, David?
Well, ultimately, I think that the Federal Reserve has to turn tough at some stage. They don't want to do it right now. They want to try and keep long-term interest rates low to encourage a full economic recovery. That's what's called sort of forward guidance. So they say, oh, we'll be very easy forever. But I think that by the fourth quarter of this year, you're going to see some very strong economic numbers, and you're going to have to see some change of tune from the Federal Reserve. I think they do need to think about, if not raising short-term interest rates, they at least need to think about, not buying government bonds at the pace they've been buying them at. And I think you'll see a tapering of that early next year. Bottom line is I do think long-term interest rates, mortgage rates are going to go up over the course of this year as this economy recovers and as the Fed begins to get a little bit more hawkish.
When they start to communicate that perhaps the recovery is so strong that they need to adjust policy or tinker with policy to some degree, will investors be confident enough in the pace of the recovery to accept that and not be fearful of it?
Yes, I think so. I mean, you can raise interest rates in an economy with a lot of momentum, and this is an economy with sort of unique potential for momentum here. You've got the sort of unique advantage of this COVID recovery, where a lot of things that can just automatically reopen when community spread dies down and we have a sufficient percentage of the population vaccinated, and you've got a very short and sharp stimulus package here, which also will help the economy. So I think raising rates in this kind of environment probably won't harm the economy, won't slow it down in any significant way. And it is important to try to get monetary policy back to balance because, low rates, yes, they're not causing general inflation, but they are causing asset price bubbles. And you can see that all over capital markets. There's a lot of distortions caused by very low interest rates. So you really don't want to keep very low interest rates in a healthy economy.
Yeah, we've got a record number of companies issuing positive guidance for earnings season as well. And yet we're talking about a situation perhaps where we see higher wage pressures, higher interest rate costs. We've not even mentioned a whopping great infrastructure spending bill that might be coming, the tax rises too. Are investors and analysts, as they look towards corporate earnings, too optimistic, whether it's this year or perhaps for the predictions that they're making for next year? And how should that play into investors' portfolios today?
Well, our analysis of the way analysts actually look at this is they're usually not too optimistic about the current year, and they are usually too optimistic about the year ahead. So I think seriously, they tend to be pessimists, and then they're smoking something when it comes to 2 years out. So we think that it will be a great year for profits. We think profits could be up 40% in terms of operating earnings per share this year. But I think 2022 will be a much harder climb because the economy will go into next year with a head of steam, but it's going to slow down as the year goes on, and you will have those stronger wages, you will have those higher interest rates. So I think earnings will grow more slowly next year. I don't think analysts have got it too wrong overall, but of course stocks are priced very high relative to that earnings expectation.
What should investors avoid, to your point about frothiness out there?
Things they really don't understand in terms of valuation. I mean, it's not difficult to sit down with a spreadsheet, look at the price of a stock, look at what the company is earning, thinking about what might it earn next year, the year after that, and ask yourself, is there any way this company will ever get back to a normal valuation? If the answer is no, then you should be careful about it. So we're seeing a real dispersion in valuations. There's some things where people are buying them at prices which just don't make any sense based on any long-term economic forecast. So I think this is last year was a year of momentum. This is a year really to think about valuations and make sure that